The ISM gives you the snapshot of where we are, and it's been around this kind of 46, 47 level for a while now. Now that's a really important level because historically that has pretty much had 100% chance of recession. And I think most of us realize we've had a recession. I think most businesses have seen a slowdown. I think many people have laid off jobs, and we're seeing, and I'll come on to jobs later, a change in the job structure. But that recession has not been called yet. We've seen the economic data, the GDP data, still somewhat buoyant. But I think it's there, and I think when all is said and done, the recession will have been called during this year. But here's the rub. I think it's actually about to start becoming over.
Anchor drop. Before we sail any further, we just need to let you know we're here to inform and entertain, not guide your gold coins. Navigate your fiscal waters with care. Let's continue. Roll out the red carpet. Introducing Raoul Pal, the mastermind behind Real Vision, the man whose fingers are on the world's financial pulse. While others are crying economic apocalypse, Raoul's got the audacious audacity to wager on an economic jackpot in the near horizon. Let's find out his secret formula for financial optimism, shall we?
Next part that people talk about all the time is inflation. Well, inflation's sticky. Again, everyone's looking at today, and you hear the central bankers say, well, inflation is too high. Well, the forward-looking stuff is vastly different, and they know that too. I think they're doing it to engineer an undershoot because they need to finance the debts, something I'll come on to later, and something I've talked on Real Vision about. So the inflation side of the story, look, this is a very ordinary inflation cycle. Yes, it went higher because of the supply issues, but if we look at this US CPI year on year versus the 5 major kind of inflationary episodes since the 1940s, the 1980s, it's pretty much identical. In fact, it's probably falling faster than most. And I don't think that it's out of the normal. Yet everybody wants to believe that something structurally has changed.
Cue the time travel music. Last summer, the CPI rate was climbing like a terrified cat up a tree all the way to 9%. Fast forward to the present, and it's lounging at a laid-back 3.7%. What magic wand was waved, you ask? The mighty scepter of interest rate hikes. Dodged the hyperinflation bullet there, didn't we?
He wants to believe that something structurally has changed, but there is no evidence of that. I don't see sticky inflation anywhere. In fact, when we look at the most similar episode, which was post-World War II, when we had the same supply issues and demand as everyone's come back into the labour force and went back home from the war, we had this huge burst of inflation. Then inflation collapsed. It went negative. Then it had the rebound, and then it continued at a low inflationary level going forwards. And I think that's pretty reasonable. Of course we will have a rebound because of the year-on-year comparisons. But is that real inflation? Not so much. We did have real inflation from the supply issues. They were real structural, well, not structural, cyclical things that were one-offs. And that's now unwinding.
Our next scene reveals the villain of last year's plot, skyrocketing gasoline prices post-Russia sanctions. But fret not, for the gas prices heroically tumbled down, dragging inflation rates along in a triumphant fall. The world gives a collective sigh of relief and a cheerful pump of gas.
Remember, when we look at those dominoes, the furthest domino back is shelter. Because shelter's incredibly lagging, even how it's calculated. So when we use the Case-Shiller Home Price Index, it's already unwound all of the inflation. It's at 0%. And that would suggest CPI shelter is also going to head down by 2025 to maybe 2%, maybe less. So this is yesterday's story, and this is going to continue to play out. And I think when the Fed get to cutting rates, they'll be cutting rates longer, as they always do after a recession, because the core lags the headline inflation, and they will focus on the core to get it down as low as possible. And before you know it, they overshoot. So they are going to be cutting rates as they see it coming down.
But what's this on the horizon? Is it a bird? A plane? No. It's the fantastic rate cut swooping in to infuse life into economic growth. With the housing market flexing its rejuvenated muscles, middle-class heroes are gearing up to reclaim their home-owning dreams. Cue the triumphant music.
So wages have started deflating massively. Here's our wage growth tracker index at GMI. It's an 11-month lead, and the Atlanta Fed version, and it's just coming lower. So wages are coming down, rents are coming down, inflation, core inflation, because these are the stickiest parts, are going to keep coming down. So I don't know where this interest rate shock is going to come from. I understand there is a supply issue in rates right now, and that's probably keeping rates higher. I understand about the deficit. I understand about financing of rates, but we'll come on to that in a minute and how that's going to play out. So when I take out shelter from CPI, it already shows CPI at 1%. So the inflation story is over.
Behold the mighty plunge in unemployment rates diving to the lowest depths in a decade, splashing waves of hope across the U.S. The convoluted tale of inflation still spins, but the charts, they're busting a groove in the right cheerful direction. The plot thickens, but the tunes are hopeful.
Spoiler alert for me is I'm really bloody bullish, and I've been bullish all year, and I was starting to get bullish at the back end of last year, and so far that's played out well. My main bets have been crypto and tech, and they've both had phenomenally good years. In fact, the Nasdaq's had one of its best ever starts to its year. Now, does that mean I'm going to be right going forwards? Who knows? I think I've done the homework. I think I know where we are, but obviously things can change. I also think that there is always volatility involved in markets as well, and the market's job is to try and throw you off. Right now, generally speaking, most people have missed the massive rally in equities, and so they're hoping that the market comes lower.
Let's zoom into the tech world, where AI stocks are riding the rocket to the moon. Whispers of a dot-com bubble echo ripple through the air. And Bitcoin, it's strutting its stuff, flaunting a doubled price tag, unfazed by economic shadows. The optimism is contagious. Catch it while it's hot.
The worst years on record for all assets. The 60-40 portfolio, for example. And I think people are still a bit scarred from that. But also, a lot of people want their comeuppance. They want their 50% crash. But I'll come into why that can't happen. So we had technology was down 70%. But the S&P and the Nasdaq, they were down kind of 30, 40%. Decent sized recessions, much like 1990 recession, nothing out of the ordinary, and they're showing the recovery. And yes, we understand that inflation is going to keep coming down lower. We understand that the ISM is showing negative GDP. We think there is negative GDP on the cards, but all the forward-looking stuff is saying we've got a recovery coming, and that's what the markets have been pricing.
And now, enter stage right, U.S. Treasury Secretary Janet Yellen shining the beacon of assurance. No financial crisis on her watch. Armed with the Fed's nimble moves and quantitative easing armor, she's guarding the gates against economic gloom.
It's like, oh, it's ticking up now. So it does come, but it takes time. And by the time non-farm payrolls are negative and inflation is below 2%, well, the market's well looked through this and it's looking for the recovery. But it also means that the cowbell, the monetary stimulus, the printing, and even the ability in an election year to add fiscal stimulus grows. And I think they want that. I think they want the excuse to stimulate. And I'll come on to why, but the election side of the cycle, of course they do. They always do. Politicians just want to hit the print button. Give you money, vote for me. That's the way the world works, sadly.
A glimmer on the financial horizon as the ISM scales the heights. The recession's chilling grip is thawing, unveiling the budding blooms of recovery. Are we gearing up for a rerun of the 2021 bull run extravaganza? If the feds keep the money presses rolling, the economic party's just getting started. Here's a golden nugget from Raoul Pal himself, unveiling his top investment secrets.
This is the exponential age, anything technology related, along with cryptocurrencies. And my chosen horse to back the most is crypto. Because that benefits very well from the liquidity cycle, yet it has the secular trend behind it. Let's say that you're not one of those people. You don't like technology, you don't like Nasdaq. Well, at some point soon, you will definitely get a cyclicals rally. So you'll probably get it in oil stocks. You'll get it in the oil price itself. You'll get it in a whole bunch of different areas of the economy. Could be banks. And that's fine too. I'm just looking to maximize my returns, and that's why I've chosen these particular vehicles. I don't see a world where we get another crash unless we've got something like China invading Taiwan. That's the favorite everybody's got. Surely we can worry about that all day, but let's play that out. China invades Taiwan tomorrow. What happens? Market's down 30%, right? Good old-fashioned crash, panic. Oh my God, nuclear war. COVID taught us the outcome. Print more money. Markets scream back.
Give that like button a high five. Click subscribe to join the Token Nation and drop a comment below. We would love to hear if you think Raoul's predictions are right.